Welcome to the deep dive. We're your shortcut to really understanding what's going on behind the headlines.
Yeah, we take all this stuff, the earnings reports, analyst notes, the spreadsheets, and boil it
But
down.
we want to give you the essential insights you actually need. And today, well, we're strapping in for a big one. Snap Inc.'s Q3 2025 earnings. Highly anticipated.
Definitely. We've got a good stack of materials here. The official press release, of course,
Yeah.
but also those crucial reconciliation tables, analyst takes from places like Reuters, investing.com, and just the raw numbers themselves.
Okay, so our mission today is simple. Move way beyond just the headline number, the stock pop, the immediate beat.
Right. We're using a structured framework, 5 parts, we call them slides, to give you that full 3D view.
We want you to see Snap's financial health, their strategy, and really importantly, what's truly driving these latest results.
And that context is just crucial for a tech company like Snap, isn't it? There are always multiple stories happening at once.
Exactly. You've got the official accounting story, that's EFAP. Then there's the cash flow story management often prefers, which is non-GAAP.
And then the expectation story, what Wall Street thought was going to happen.
So we'll guide you through reconciling those. You need all three perspectives to really get why the stock did what it did.
Okay, ready to dive in.
Let's do it. Okay, let's unpack this with slide 1, the at-a-glance scorecard.
All right, this is the first look. The immediate temperature check.
And spoiler alert,
Yeah.
it was pretty warm. How did they stack up against expectations?
Well, it was a decisive win, really, on both the top and bottom lines. Let's start with revenue, the big top-line number.
Okay.
Snap reported $1.507 billion in total revenue.
And the estimate was?
Consensus was sitting around $1.49 billion.
Yeah.
So they didn't just squeak by, they comfortably beat it. Solid growth there.
Solid, okay. But the real excitement, the thing that got the market buzzing, that was the EPS, right? The earnings per share.
Oh, yeah, that was the kicker. The company reported a diluted net loss per share of only 6 cents. So $2.06.
Only 6 cents loss, and the street expected.
Get this, the consensus estimate, according to investing.com, was for a loss of 12 cents per share. $2.12.
Wow, so they literally cut the expected loss in half.
Exactly. That's a massive surprise. Huge beat on the bottom line.
And you saw that play out instantly in the market reaction. What was it, 20%?
Yep. The stock rose more than 20% in after-hours trading, right after the announcement on November 5th. Market sources confirmed that.
And the analysts, what was their immediate take?
They jumped on it pretty quickly. Reuters mentioned the narrative was forming around higher user engagement and just strong operational performance. They specifically pointed to beating the adjusted EBITDA estimates, too.
So from Wall Street's point of view, just a clean sweep. Beat, beat, beat.
Pretty much. Exceeded expectations across the board.
Okay, so that's versus expectations. Now let's look internally. Q3 this year versus Q3 last year. What's the year-over-year picture?
The improvement story continues there, and it's quite striking, especially on efficiency. Total revenue, as we said, grew a solid 10.5% year over year.
10.5% growth. Okay.
But look at profitability. The net loss, it improved by 32.4%.
32% better. So shrinking that loss significantly.
Yeah, it went from over $153 million last year down to about $103.5 million this quarter. And that flows right through to the diluted EPS.
Which improved by?
33.3%. A massive improvement, going from a loss of 29 last year to $2.06 this year.
Okay, hold on. That's the number that jumps out. EPS improving by 33.3%, but revenue only grew 10.5%.
Exactly. That's the central puzzle of this first slide, isn't it?
How do you improve your bottom line 3 times faster than your top line? That needs some explaining.
Right. We need to figure out how they pulled that off. It wasn't just revenue growth driving it.
Before we solve that puzzle, though, let's quickly clarify something technical. Basic versus diluted EPS. We see both on the statement, and it often trips people up, especially when there's a loss.
Yeah, it's a great point. And honestly, GAAP rules can feel a bit weird here. Basic EPS is simple enough. Net income, or in this case net loss, divided by the average shares actually out there.
Just the shares currently trading.
Right. Diluted EPS is supposed to be the more conservative number. It calculates what happens if all the potential shares, think stock options, RSUs, convertible debt, suddenly became real shares.
So for a profitable company, more shares means the earnings get spread thinner, lower EPS. Dilution. Makes sense.
Correct. But here's the twist for a company with a net loss, like Snap. Those potential extra shares, they're considered anti-dilutive.
Anti-dilutive, meaning?
Meaning adding them would actually make the loss per share look smaller. Think about it. A $100 loss divided by 10 shares is a $10 loss per share.
Yeah.
Now add 10 potential shares. Suddenly it's a $100 loss divided by 20 shares. That's only a $5 loss per share.
Ah, so adding the potential shares makes the loss look better, less bad.
Exactly. And GAAP rules say, you can't do that. You can't make your net loss look artificially better just by including hypothetical shares.
Got it. So if you have a net loss.
GAAP forces you to say your basic and diluted share counts are the same. They're identical. That's why the income statement clearly shows the same weighted average share count for both basic and diluted in Q3 2025 and Q3 2024. No anti-dilution allowed.
Okay, that makes sense. Thanks for clearing that up. So back to the big question, 33.3% improvement in loss per share, only 10.5% revenue growth. Did they just buy back a ton of stock? Shrink the share count?
That's usually the first place you'd look, right?
Yeah.
Boost EPS by reducing the S, but nope, the data shows the opposite.
Really?
Yeah, the weighted average diluted share count actually went up by 2.0% year over year.
It increased from what to what?
From about 1,663 million shares to 1,696.5 million shares.
So more shares outstanding, mostly from stock compensation, I assume.
Primarily, yes,
Yeah.
stock-based compensation. So that 2% increase was actually a headwind. It worked against EPS improvement.
Wow, okay. So the underlying operational performance must have been even stronger to overcome that 2% drag and still deliver a 33.3% improvement.
Precisely. That makes the performance even more impressive.
So what were the levers? There must be two key drivers for shrinking the net loss so dramatically.
There are two main ones. First, and this is the really important one for the long term, operating leverage.
Operating leverage, explain that for us.
It's kind of the holy grail for maturing software platform companies. Simply put, it means your costs grew much, much slower than your revenue grew.
Okay. We saw revenue grew 10.5%. How did costs compare? Total operating costs were, what, $1.635 billion?
Right. But listen to this. Those operating costs only grew by 5.8%.
Only 5.8% cost growth versus 10.5% revenue growth. That's the leverage.
That's it, exactly. They're finally getting real economies of scale. Because revenue outpaced costs so much, their operating loss shrank dramatically, by 25.9% actually.
26% reduction in operating loss from what, around $173 million down to $128 million.
Yep, $173.2 million down to $128.4 million. That's pure operational efficiency kicking in.
Let's just pause on that operating leverage idea for a second. Why is this such a big deal for investors looking long term? Give us an analogy.
Okay, think about it like building a factory. When Snap started, they had huge upfront costs, right? Building data centers, developing the core tech, all that fundamental R&D. Very expensive for each early user or ad.
Right, big fixed costs.
Now, a lot of that is built. The cost to add one more user or sell one more ad impression is way, way lower now. The marginal cost has dropped.
So like that new AR lens feature costs a bunch to develop, that's fixed. But if it brings in millions of new ad views...
Exactly. The revenue scales up massively, but the initial R&D cost stays the same. The millionth ad view is much more profitable than the first one was.
So that 25.9% reduction in operating loss is proof that new revenue dollars are coming in much more profitably.
That's the key takeaway. It shows the business model is maturing. That's lever number one.
Okay, what was lever number two? You said it was less operational, more financial.
Correct. The second big factor was a significant swing below the operating line, as they say, in the non-operating income section.
Things like interest income on their cash.
Primarily that, yeah. Look at Q3 last year, 2024. Snap actually had a $25.2 million loss in the other income expense net line.
A loss there, okay.
At this quarter, Q3 2025, probably thanks to higher interest rates earned on that big cash pile they have, that line item flipped completely.
Yeah.
It became a substantial gain of $27.6 million.
Whoa. From a $25 million loss to a nearly $28 million gain. That's a $52.8 million positive swing?
It's huge, massive swing. And well, look, it's not core operations. It's not selling more ads or subscriptions. That $50+ million boost from non-operating items was a major contributor to pushing the overall net loss down by that impressive 32.4%.
So summing up slide one, the big EPS beat came from two things. Real, genuine operational efficiency showing up as operating leverage.
Combined with a very helpful, significant financial tailwind from non-operating income, both working together.
Okay, that makes perfect sense. And it sets us up beautifully for the next stage. We know they're getting more efficient, shrinking the loss, which leads right into profitability metrics and those different accounting views.
Exactly. Moving to slide 2, the engine of profitability. This is where we look hard at the margins and tackle that sometimes confusing difference between the official GAAP story and the adjusted story management likes to tell.
Let's start with the official story first. GAAP margins. How did they look?
They confirm the efficiency story we just talked about. Take gross margin. That's your profit after the direct costs of delivering the service, servers, bandwidth, paying creators, stuff like that.
Right. Q3 last year, you said gross margin was 53.4%. Where is it now?
It ticked up nicely to 55.3%.
Okay, 55.3%. That's a gain of 1.9 percentage points, or 190 basis points. What does that tell you?
It's a strong signal of better technical efficiency. They're delivering the core Snapchat experience, sending snaps, viewing stuff, running ads at a lower cost relative to the revenue it brings in, good management of core and infrastructure costs.
And then operating margin. That includes all the other stuff, R&D, sales and marketing, G&A, overhead. That showed an even bigger jump, didn't it?
Oh yeah, much bigger. Remember, the operating margin loss in Q3 2024 was 12.6%, a 12.6% loss.
And this quarter?
It improved significantly to a loss of only 8.5%.
Wow, from 12.6% loss to 8.5% loss. That's 4.1 percentage points, 410 basis points of improvement.
A massive 410 basis point improvement. That right there is the clearest number proving out that operating leverage story we discussed in slide 1.
It's not just a concept, it's showing up directly in the margins. Measurable progress.
Absolutely. These margin improvements, both gross and operating, are the best evidence that Snap is genuinely on a path towards real, sustainable GAAP profitability. If they keep this up, getting to black ink on the bottom line feels achievable.
And here's the big but. This is where things get tricky. The official GAAP net loss was $103.5 million. We established that.
Right, the legally required number.
Yet, management's preferred metric, the one they highlight, adjusted EBITDA, that show a profit of $182.0 million. How on earth do you get from a $103 million loss to a $182 million profit? That's like a $285 million swing. What's going on?
This is that big reconciliation we talked about.
Okay.
And it's crucial for you, the listener, to understand. Non-GAAP, or adjusted EBITDA in this case, is management's way of showing the underlying cash operational performance.
Their argument being?
Their argument is that certain big non-cash expenses, while required by GAAP, kind of obscure the true day-to-day health of the business. So they add those non-cash items back to the net loss number.
Okay. So they start with the GAAP loss and add stuff back. What's the biggest add back? When you look at that reconciliation table, one thing just leaps out.
Oh, it dominates. By far, the single largest add back is stock-based compensation, SBC. For Q3 2025, that was a staggering $260 million.
$260 million just in stock comp in one quarter.
Yep. So think about that. The entire positive adjusted EBITDA profit of $182 million. It only exists because management added back $260 million in stock compensation costs.
If they hadn't excluded that $260 million SBC cost, the adjusted EBITDA would still be negative, deeply negative.
Exactly. That's the fundamental point you have to grasp.
Yeah.
Management is basically saying, look how profitable our operations are. If you ignore this $250 million we paid our employees in stock.
Which feels problematic. I mean, SBC isn't some accounting fluke. It's how Silicon Valley works. It's a core part of attracting and keeping talent. It's a real expense, just not paid in cash right now.
It's absolutely a real expense to shareholders. That's the critical link. While it's non-cash to the company in the immediate quarter, it's the very thing that causes shareholder dilution, the share count creep we saw in slide 1.
Right. It's value transferred from existing shareholders to employees over time. It has a very real cost.
So that $182 million adjusted EBITDA profit, but the total cost structure, including how they pay people, still results in a GAAP loss. It highlights this ongoing tension. The business generates cash, but the cost of talent paid in stock is immense.
Okay, that clarifies the GAAP versus non-GAAP picture. Operationally getting better, but SBC remains a huge factor.
Precisely. So let's move on from the accounting definitions and look at where the actual money is coming from. Time for slide 3, the engine room business segment performance. Where are the real growth drivers?
Okay, let's slice the revenue pie. First, geographically, where's the growth coming from around the world?
Well, North America is still the giant. It's nearly 2/3 of their business, about 64.3% of total revenue.
The backbone. But growth-wise?
It's the slowest growing segment, only 7.9% year-over-year growth.
Okay, 8% growth in their biggest, most mature market. That makes sense. It's a drag on the overall average, though.
It definitely is. That's the challenge of relying so heavily on a saturated market. It pulls down that overall 10.5% company growth rate. But the diversification story looks better elsewhere.
Where was the strength?
Europe was the clear standout. It accelerated, growing at 15.3% year-over-year.
15% in Europe. That's almost double North America's rate. And rest of world?
Also solid, grew at 11.1%, so faster than North America too.
Why is Europe doing so much better? Any specific reasons?
Seems like a few things are clicking there. Analyst commentary suggests that while the U.S. digital ad market is hyper-competitive, Snap is still actively gaining market share in key European countries.
So, stealing budget from rivals.
Potentially, yeah. Plus, they've likely been focusing on localizing content, maybe rolling out AR features popular with European brands. The market there might just be less mature, offering more room to grow compared to the U.S.
Okay, so successful diversification geographically, even if the biggest piece is slow. Now let's look at the type of revenue. Core ads versus this other revenue.
Right. Core advertising, especially direct response ads, the ones asking you to click or buy something, now that's still the foundation. It was up a respectable 8%.
8% for core ads. Okay.
And within that, there was a really bright spot, purchase-related advertising. Ads driving actual e-commerce sales. That subsegment grew over 30%.
Over 30% for purchase ads, that's strong. It means advertisers are seeing real ROI, right? Not just brand awareness.
Exactly. It suggests Snap is becoming a more effective tool for performance marketing, which is crucial. Solid, but like you said, not explosive growth overall in ads.
The explosion seems to be hidden in that line item called other revenue. What's in there?
This is it. This is the mic drop moment of the quarter. The major revelation. Other revenue, which management explicitly says is mostly Snapchat Plus subscription revenue.
Okay.
It grew an absolutely explosive 54% year over year. 54%, reaching $190 million for the quarter.
54% growth for the subscription service. That's incredible, especially when ad growth was just 8%.
It is incredible, and we need to really let that sink in and understand the sheer impact of that number. Forget the percentage for a second. Let's look at dollars.
Okay, break it down.
Snap's total revenue grew by $134.2 million this quarter compared to last year. That's the total increase across the entire company.
Got it. Total new money, $134 million.
Now, the other revenue segment, it was $190 million this quarter. Doing the math based on the 54% growth, it must have been around $123.4 million in Q3 last year.
Okay, so the increase in subscription revenue was $190 million minus $123.4 million, about $66.6 million.
Roughly $66.6 million in absolute new revenue came just from Snapchat plus NAF. Now compare that to the total company growth.
$66.6 million from subs divided by the total $134.2 million new revenue. Carry the one. That's almost exactly half.
It's 49.6%. Nearly half of Snap's entire year-over-year revenue growth came from Snapchat Plus subscriptions.
Wow. That's not a side business anymore. That's rapidly becoming the growth engine.
It is utterly transformative. This high-margin recurring revenue stream isn't just nice to have, it's taking over.
And for an investor, why is recurring subscription revenue so much more valuable than ad revenue?
Predictability and stability. The market loves recurring revenue because it's sticky. Ad spending is cyclical, right? Economy dips, ad budgets get slashed instantly, revenue becomes volatile.
But subscriptions?
Subscriptions tend to be much more stable. Once someone signs up for, say, $3.99 a month, they often just keep paying. It gives management much better visibility into future earnings, less dependence on those economic swings.
So fundamentally, this is de-risking Snap's entire business model. They're shifting from being just an ad company,
Which typically gets a lower valuation multiple.
to becoming more of a platform monetization company with a significant, stable, recurring revenue base.
Which commands a higher multiple in the market. That 49.6% contribution number. That could be the single most important data point for Snap's future narrative and valuation.
It changes everything. The story shifts from can they compete in ads to how fast can they grow this sticky subscription base.
Absolutely. Huge strategic validation.
Okay. We understand the growth engine now. Let's check the foundations. Moving to slide 4. Financial strength and shareholder rewards. Is this growth built on solid ground? Let's look at the balance sheet.
Right. First check is always liquidity. Can they pay their short-term bills? And the answer here is a resounding yes. They are sitting on a mountain of cash, $3.0 billion in cash, equivalents, and marketable securities.
$3 billion in ready money. And the current ratio, assets versus liabilities due soon.
It's exceptionally strong. We're looking at about $4.48 billion in total current assets versus $1.22 billion in total current liabilities.
Okay, divide assets by liabilities.
That gives you a current ratio of 3.67.
3.67. And anything over 1.0 is considered safe, right?
Generally, yes. So 3.67 is fantastic. Means for every dollar they owe in the next year, they have almost $4 in liquid assets ready to cover it. Short-term financial risk. Very, very low.
Right, liquidity is rock solid. What about long-term debt? leverage. That can sometimes be a concern with tech companies financing growth. They have about $3.5 billion in long-term debt, net.
Yep, $3.49 billion. We assess that using the debt-to-equity ratio. Compare total liabilities, which are about $5.35 billion.
Against total stockholders' equity, which is around $2.23 billion.
Right, so $5.35 billion liabilities divided by $2.23 billion equity gives you a debt-to-equity ratio of 2.4.
2.4. How does that stack up? Moderately high.
I'd say moderately high, yes. It tells you Snap is financing more of its assets and operations using debt rather than equity.
Which isn't necessarily bad, but
But it does create that ongoing drag on GAAP earnings because they have to make those interest payments. Given their huge cash pile, they can clearly handle the payments now, but it's a structural cost to be aware of. It adds a bit of financial risk compared to having no debt.
okay, so strong liquidity, moderate leverage. Now, shareholder rewards, dividends.
Still none. Typical for a growth-focused tech company. They're reinvesting everything back into the business.
But they did announce something important on the capital return front this quarter, a new buyback.
That's right. The board authorized a brand new stock repurchase program up to $500 million. And importantly, this is new. The report confirms 0 shares were bought back during Q3 itself. This authorization is for the future.
Okay, $500 million for buybacks. Now, connect this back for us. Slide 2, we talked about that massive stock-based compensation cost. How does this buyback relate?
This is where you have to read the fine print. Management was very explicit about the purpose of this buyback. They stated it's to opportunistically offset a portion of the dilution related to the issuance of restricted stock units to employees.
Offset dilution. So this isn't about thinking the stock is cheap and returning excess cash to boost shareholder value.
Not primarily, no. This is basically damage control. It's a defensive move. Think about it. We saw SBC was $260.4 million in one quarter.
Annualize that.
Yeah.
It's over $1 billion a year in stock compensation potentially hitting the share count.
Exactly. Over $1.0 billion in annual dilution from SBC. And this new buyback authorization is for $500 million.
That doesn't even cover half the annual dilution from SBC.
Precisely. It's not enough to actually reduce the share count over time. It's just trying to slow down the increase. They're spending $500 million essentially just to tread water against the share count inflation caused by their own compensation practices.
So investors shouldn't see this $500 buyback as a sign of massive excess cash being returned. It's more like structural maintenance.
That's a perfect way to put it. It's a necessary cost of doing business with their current compensation structure, using cash flow, just to try and keep the share count somewhat under control. It prevents EPS from being penalized even more heavily by dilution.
Got it. That really frames the capital allocation strategy. Great liquidity, manageable debt, and a buyback focused on offsetting SBC dilution.
Okay, that covers the financial plumbing. Let's bring it all together now. Time for our final section, slide 5. The road ahead management's outlook and key takeaways.
All right, the synthesis. What did management say about the future? Any forward guidance?
Well, the CEO, Evan Spiegel, put out the usual confident commentary, focused on things like performance, creativity, and simplicity, driving results, aiming for durable long-term growth. Standard positive CEO talk.
Did they give specific numbers for Q4 revenue or EBITDA targets?
Not in the press release itself, no. That's typical. They usually provide that detailed financial guidance during the earnings call with analysts or in a separate investor letter that follows the release. So no hard numbers in this initial document.
Okay, so let's synthesize our key takeaways then. Based on our analysis across all 5 slides, what are the core conclusions you want our listener to walk away with?
I think there are 4 main things. First, the headline, a decisive beat. No question about it. Clear win on revenue. 1.507B versus $1 civil 9 beat estimate, and especially on the bottom line, EPS loss of 0.64 612 sales estimate. That's why the market reacted so positively with that 20% plus stock jump.
Okay, takeaway 1, clear beat. What's number 2?
Number 2 is the engine. The Snapchat Plus engine is firing. This is huge. That subscription revenue growing 54% year over year, it contributed nearly 49.6% of all the company's new revenue growth. This confirms their diversification strategy is working brilliantly and fundamentally changes the risk profile and growth story.
Takeaway 2, Snapchat Plus is the star. Got it.
Third is the plumbing getting better. Real margin improvement. We saw it clearly. Gross margin up to 55.3%, operating margin improving by a massive 410 basis points. This isn't just hope. It's proof of operational efficiency and maturing cost control. They're on a measurable path towards GAAP profitability.
Margin expansion is real. Okay. And the final takeaway, The necessary caution.
Yes, the caveat. Number 4, the SBC caveat. You just can't ignore it. That nice $182 million adjusted EBITDA profit. It hinges entirely on excluding $260 million in quarterly stock-based comp. That SBC is real, it drives dilution, and it's the direct reason they need that $500 million maintenance buyback just to manage the share count.
So profit is only visible if you ignore a major structural cost. Okay, that's a crucial piece of context.
So putting it all together, Q3 2025 for Snap looks like a story of really solid strategic execution. They leveraged efficiency gains, successfully pushed diversification through subscriptions, and are actively, if defensively, managing that big SBC cost via buybacks. It felt like a confident quarter, showing resilience.
Yeah, and looking at it through this structured 5-slide approach really helps cut through the noise, doesn't it? You move past just the stock price pop and see the why behind the numbers.
Absolutely. It helps you identify the real drivers and also the ongoing challenges.
So here's a final thought for you, the listener, to chew on. We saw Snapchat Plus growth accounted for almost half the new revenue this quarter.
Yeah, 49.6%.
What does it mean for Snap's valuation down the road if that trend continues? If non-advertising, sticky recurring revenue becomes the dominant part of their business, what does that imply not just for Snap, but maybe for the whole social media advertising model itself? Something to think about.
Definitely food for thought.
Okay, before we wrap up, the standard reminders. This was not financial advice. We're analyzing information, but you absolutely must do your own research before making any investment decisions. Also, this analysis was generated with the assistance of AI.
Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our library of S&P 500 stocks and NASDAQ 100 library we're building out, and also get priority requests for company deep dives.